Santam increased its final dividend despite a challenging year that saw it pay a record 29.8 billion rand in gross premiums due to flooding, load shedding related power outages, fire and crime. The short-term insurer achieved an 8% growth in conventional insurance gross written premiums, which topped 35.4 billion rand for the year. For more, we are joined by Thava Mazinga, who is Santam's Group CEO. Thava, thank you so much for your time. I mean, looking back at the period that was, and I mean, you did highlight it a few months ago when we spoke, that it was quite a challenging 2022. But how should shareholders look at the performance so far for Santam?
No, thank you very much and good afternoon, viewers. I think while 2022 was a very difficult year for P&C globally and also for us here in South Africa, I think the result that we've delivered for the year 2022 is a fair result. I think we saw a number of items coming through. We saw the KZN floods. We've seen the impact of inflation on our business. Motor theft is also up. And then to bring it all together, we also saw volatility in the investment markets. But I think for us as a business that's been in business for 105 years, all these perils are largely manageable. And I think the perfect storm that we saw in 2022, I think speaks a lot to the resilience of the business, that despite a tough environment, we've been able to pay a record just under 30 billion in claims to help our customers and consumers weather the economic shocks and the challenges that they've faced from some of these perils. And then from a shareholder perspective, we are quite confident in the sustainability of our business on a go-forward basis. And so we're quite comfortable with the dividend that we've declared.
On that note, then, what are you seeing when it comes to the performance from an underwriting level?
No, thank you. So I think what we're seeing is that our underwriting result is at the bottom end of our range. But I think typically in a business such as ours, we expect volatility in the underwriting result, but it's well within the range that we expect of 5 to 10%. And then from financial stability of our business, the capital and that underpins our business, we're fairly comfortable that we can weather these type of events, now and into the future. And then from an underwriting perspective, obviously, we've had to work with our customers and our clients to try and manage the impact of claims and of risks to a large extent. And so if you look at motor theft, we've worked with car manufacturers. We're asking our clients to be a little bit more vigilant. We're asking them to put in particular makes of tracker devices so that we can keep the cost of claims down. We are very mindful that our clients are facing significant consumer pressure from inflation. Interest rates are up. And so we're quite mindful of the environment in which we're operating and really trying to work with our customers to providing them with cover against some of these adverse perils.
Speaking of adverse perils, I mean, are you able to quantify the impact of load shedding on the business? And what kind of risk mitigation sort of action have you taken in order to, I suppose, balance the risks of grid failure, I guess?
So we have seen an increase in claims that are coming through from power surge. But I think it's important to put it in perspective that while it is a topical item at this point in time, in the 30 billion of claims that we've paid out, whether it's KZN or to our other customers from other perils, the impact of power surge at this stage, it really is fractional. And so it is a risk that we largely at Santam believe is insurable. And so we do continue to offer power surge to our clients. We are evidently concerned, similar to everybody in the country, about the systemic losses that could arise from potential grid failure. And so we are working from an underwriting perspective, working with our customers around putting surge protectors to really reduce the risk and the impact of power surge claims. But I think to put it in perspective, it is a fractional number that we are seeing in terms of the total claims that we experienced in 2022.
Are you able to expand on what you're experiencing when it comes to the My Way side of the business?
So the byway side of our business has improved from an underwriting perspective. So we've seen the underwriting and profitability improve in that business, although growth was muted, which really is reflective of the tough economic environment that our customers and clients are facing in that particular part of our business. But I think on a go-forward basis, we've been quite pleased with the operational performance of the business. Very tight operational management, tight claims management, and so the operational side of the business has really performed in line with our expectations. And so, looking ahead into 2023, we really are looking to grow the My Way business as we move forward.
As we look ahead, then, what will you and the team be focusing on?
I think for the year 2023, coming out of a very tough 2022, we're very mindful, of the inflation challenges, supply chain disruption. We've seen what's happened in the global space, and so, we are cautiously optimistic for a better 2023. While we do expect, our fair share of rain and hail across the country, we are hopeful that we don't get a convolution of all the factors that we saw in 2022. And so, we are cautiously optimistic about the year ahead. And I would like to encourage our customers, that, Santam is a trusted brand and that we do continue to provide the myriad of covers that allow customers and consumers to protect themselves against vulnerabilities from some of these perils.
Tava, thank you so much for your time. Let's leave it there. That is Tava Matsinga, who is the CEO of Santam. Moving on to market news now. A rally in Asian shares sputtered, pressured by a pullback in Chinese stocks and higher U.S. yields, amid fears that global central banks would keep rising interest rates to combat sticky inflation. Japan's Nikkei, on the other hand, eased to 0.1%, and Hong Kong's Hang Seng Index retreated 1% after registering the biggest daily gain of 4.2% in nearly 3 months. That was the previous day, buoyed by unexpectedly robust readings from Chinese purchasing manufacture index surveys. Locally, however, private schooling group Kuro reported a dip in profit in its latest annual results, despite a jump in revenue and higher enrollment as it expands to meet the growing need of parents willing to pay for private education. Profits decreasing 6.4% year-on-year to 235 million rand, while impairments and higher financing costs also ate into profit. However, to talk to us about the latest when it comes to the markets, we are joined by Patrick Matidi from Aluwani Capital. Patrick, thank you so much for your time. Your sense of global market sentiment right now, given the fact that investors are still concerned that central banks will keep hiking for longer?
Yeah, good afternoon, Natasha, and thanks for having me. Indeed, there is that sense of discomfort. If you think back, late last year, early this year, there was a sense of optimism that indeed inflation had peaked in major global economies, and as a result, from this point onwards, we could expect inflation to sort of ease off with the prospects of rate cuts to come through at least towards the end of that year. That thesis has since, evaporated. We are now still caught up, in this higher for longer environment, and you're seeing that the markets are being a bit skittish, rallying but then selling off, as and when economic data comes through.
So quite a lot of results out today, whether you were looking at Kuro, Grindrod, Santam. But let's discuss First Rand, which was one of the other companies that published their figures. What did you make of the numbers?
Look, I think the numbers were a lot better than at least what we had expected. So First Rand reported the interim results to the end of December. That's got a June year end. And at the headline level, that was up about 15%, driven largely by F&B. That did very well, up about 17%. And then followed by West Bank, and then also the corporate bank, which is RMB, up at about 28%. So a good number all around, to the extent that, they felt comfortable to also increase their interim dividend by about 20%. Which is very good, especially in this environment where we are seeing a lot of companies conserving capital, just given the tough environment that is out there. So good numbers all around from our side.
So speaking of the environment, let's talk about it from a client perspective. Are clients looking for opportunities? Is it they buy the dip, so to speak, or are they sitting on the sidelines slightly fearful?
Look, we saw, the rally that I mentioned, sort of late last year, early this year. A lot of cash did come into the market, but we're seeing some of it now, actually, people taking profits. And we've had a few headwinds, that has sparked those concerns. So over and above just global inflation and interest rates, locally, Now we still have the issue with the load shedding. We just saw last Friday, with the grey listing. So we are seeing, some money being pulled out of the market, perhaps waiting for better buying opportunities. But for us, the standard advice is always, timing the market as opposed to timing the market, because it's very difficult to get the timing right. So rather remain invested and hopefully live through the bumps as and when they occur.
On that note, then, what's your allocation strategy looking like? Are you looking for companies with a strong balance sheet, free cash flow, and possibly, consistent dividends? Or what exactly is piquing your interest?
Yeah, I think that's the overriding criteria for quality, given those factors that you mentioned. But also, we are looking at the companies that have got what we call a self-help story. So in other words, they can navigate the macro environment, and their investment thesis is not really predicated on what happens with interest rates or whatever. So they've got a bit of pricing power, they've got low debt in the balance sheet, and they've got a growing market share where we are seeing sort of a margin opening up. And I have to confess, given those criteria, it's very difficult to find companies that fit into that mold. But also, to your question, we are looking at other asset classes. So, for example, government bonds are looking very attractive, just given the sell-off we've seen after grey listing. And then also, with the whole energy shortage, we are seeing companies that are looking for solutions. And then from an attractive point of view, that makes a bit of sense for us, because that means that they are able to kind of hold on to a market share, going forward.
It's the 2nd of March. However, let's look back at the month of February. What would you say were the main themes for you?
Look, clearly, grey listing was one of those. The budget was another. But also, I think after the decent rally that we saw Q4 last year and also into January, the change in tone and sentiment from a global perspective in terms of higher for longer, I think, that almost set the tone for the rest of this year. So if you look at food inflation, for example, that is still running very high, which means that it's very unlikely that we'll see a rate cut coming through anytime soon, which clearly is a big step change from what we had anticipated going to the end of last year.
We still have quite a few companies yet to release their financials, at least on SENS, that is. Any particular companies you're going to be paying attention to, or even specific sectors?
Look, I think we've just seen first time today, so the rest of the banks should report over the next few days. We've had some trading updates the last couple of sessions, so we can have some sense as to what to expect, but it's always good to actually get the results and get confirmation. We're seeing also on the resources side, especially the platinums, results coming through. There, unfortunately, the picture is not as great as what we are expecting on the banks and the financials, and then also on the financials in terms of reporting. We look out for the life companies, your Old Mutual, your Sanlam. Those are also expected to report over the next couple of days, and then followed by the property guys. Again, I think property and commodities is still an area where we should expect a lot of bad news, just given the macro headwinds that the guys have been facing over the last while.
Right. Patrick, thank you so much for your time. That is Patrick Matidi from Aluwane Capital giving us his perspective on the markets. Let's take a quick break. When we come back, we'll speak to the CEO of FNB.